get my glasses on, just in case. And we'll call the October 10th, 2024 meeting of the Retirement Board to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of September 12th, 2024. Have a motion and a second. Please record your vote. Item is approved. Item number 3 is a presentation from Investment Manager Allspring. Jason, do we just want to go ahead with the rest of the docket and then we can go back to them? Okay. All right, well, we'll jump to item number 4, which is the consent docket. We have 2 items. You have a motion and a second. Please record your vote. Item is approved. Item number 5 is to ratify approvals. We have 2 items. We can take those with one motion. We have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 7 is to approve the following applications for service retirement. We have a motion and a second. Please record your vote. Item is approved. Item 8 is approved continuation of pension to spouse. We have 2 items. We have a motion and a second. Please record your vote. Item is approved. Item 9 is receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 10 is receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item 11 is approve the request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second. Please record your vote. Item is approved. Item 12 is items for individual consideration. Item 12A is approve retirement system employees to enroll in courses offered by the International Foundation of Employee Benefits to pursue the Retirement Plans Associate designation. Have any questions? Have a motion and a second. Please record your vote. Item is approved. Let's go ahead, if it's okay, let's jump back to our first item, item 3, and have our presentation from Allspring. Jason, you want to give us a little introduction?
Good morning. This is just a regular update from Allspring, which is your dedicated emerging markets manager. Last month we heard from your 2 developed market managers, and today we'll hear from them about their portfolio and their outlook on emerging markets. Turn it over to you, Mexico.
Thank you, Jason. Hi, thank you for having us, and thank you for being a client since 2016 of our firm. My name is Michael Warren. I'm with the Client Relationship Group at Allspring, and with me is Derek Irwin, one of the portfolio managers for the strategy that you have with us. And we haven't been here in 3 years. I distinctly remember being here because I think for both of us, it was the first trip we took post-pandemic back in October of 21. So it was good to get it started again, traveling, and it's good to be back here. So given that we haven't been here in 3 years, I thought I would have Derek just walk through the performance of the strategy since that time, and then conclude with an outlook on what the current market is like and what we see for the market going forward and how we're positioned for it. So if that sounds okay to everyone, I'll turn it over to Derek. Thank you.
Perfect. Thank you so much. It's nice to see, nice to be here again. I can tell you the last time I was here, the planes were not quite as full. It was a hell of a trip coming down. So things are back to normal, which is great. So as Mike mentioned, last time we spoke was 2021. And I thought I'd take you through the last 3 years, both within emerging markets and with our strategy, and then hopefully talk a bit about what we can expect going forward. For following along on the book, why don't we turn to page 12? I hope to take about 20 minutes if that works for you, but feel free to stop me with any questions along the way. So this is really just a number of charts that talk about how emerging markets have done over a variety of time periods. And I'm going to focus on one or two of them. On the top right of the page, you can see how we've got emerging markets versus some of the other big benchmarks, the S&P, the EFA, which is developed markets, as well as the ACWI, which is the whole world. And what stands out, if we look at the 3-year number, is not much has happened. I guess statistically speaking, since last time we spoke, emerging markets are effectively flat in that period, although that certainly hides an awful lot of volatility. And of course, you can see more recently over the 1-year period and into 2024, we've had a little more activity in the emerging markets, which is nice to see. But really, the 3-year period, emerging markets has been pretty lackluster. And I think there's really two big drivers of that sort of soft performance in emerging markets. One, of course, is China, which I'm sure you're all familiar with. They made a number of policy mistakes, internal policy mistakes during that period, particularly in 2021. And then the fact is, as they went through COVID and exited COVID, they really compounded those mistakes. And China has been a pretty significant underperformer versus the rest of emerging markets, which has held in there pretty well. Of course, China is a very big piece of our universe. So the gravity of China has really dragged down the overall EM performance. And then second, I think post-COVID globally, as we know here, we really have seen a number of economic shock waves from inflation going up and spiking to coming down more recently, interest rates globally rising very, very quickly, and of course, a general decline in global trade. And I think that we're seeing performance in emerging markets pick up recently, I think in part because some of those post-COVID shock waves, as it were, are beginning to relax and maybe fade. And we're starting to see some, I think, fundamental interesting opportunities within emerging markets. And hopefully a lot of that post-COVID turmoil is behind us now, as we've seen on the 1-year numbers there, up 26%, which is not too bad. In terms of our strategy, we have underperformed during this period, which is disappointing. On a 3-year basis, this is page 15, the strategy on a gross basis is down about 1.53% versus, as I said, roughly flat for emerging markets. And I want to unpack that, if I could, very briefly. And maybe the easiest way to do that is to flip one page forward to page 16. And this breaks down emerging market and the strategy's performance on an annual basis over the last 5 years. And you can see, if you look at 2021, was a dramatic, challenging period for us, where we actually had our worst one-year period of underperformance versus the benchmark ever. And it's been a real drag on the three-year numbers. And I think to unpack that a little bit, of course, we were coming out of COVID, as you know. And surprisingly, despite COVID, despite the real global challenges we had there, 2019 and 2020 were very good years for both emerging markets and for our strategy, where we outperformed very significantly. And it's almost fair to say, despite the rude interruption of the big global drawdowns in 2020, by the time we got into 2021, we were really at the tail end of what I would consider a bull market in emerging market assets. And we were positioned as such. Generally speaking, as we reach a more mature bear market, we are trading out of some of our more highly valued positions into areas of the market that we think are a little more stable. And we were certainly doing that through the first half of the year, which was quite strong. In the second half of the year, really basically starting July 1st, two important things happened. First, as I mentioned, China embarked on a really unprecedented regulatory crackdown, almost to the day on January 1. You may recall the term that they don't talk about anymore because it's a huge mistake, called common prosperity. And effectively, it was a wave of regulation within the private sector that kneecapped a lot of very, very fine private sector companies where we had pretty significant exposure. And so that bull market in emerging market equities was really chopped down at the knees. We were moving toward a more conservative stance, but not quickly enough for a market that effectively collapsed in the second half of the year. And then the second piece of underperformance in that period really related to something I think we can kind of relate to here. Brazil and other parts of emerging markets were not immune to post-COVID inflation. In fact, emerging markets were some of the first countries to really experience significant deflation. Places like Brazil were probably the canary in the coal mine. They saw their inflation rate go from 4% to 14%, almost overnight. And we saw dramatic increases in interest rates as a result. So in 2021, the Brazilian central bank raised interest rates by 7.25%, followed by another 4.5% in 2022. And for perspective, those are the two largest interest rates in well over 20 years, even for Brazil, where they really understand interest rate hikes. So that emerging market bull market that we'd enjoyed for 2 years was really cut off at the knees, and unfortunately, we were not appropriately positioned for that. I will say to really underscore that, we made some positioning errors. We just didn't anticipate either of these events as aggressively as we should have. And I would say two things in particular that we've examined over the last 3 years very aggressively. And the first one is a little bit technical, but really important. We watch our risk in our portfolio very, very carefully on a daily basis. And our risk parameters were, generally speaking, within the parameters that we've set for this strategy. And so as we went through the strategy afterward to figure out where there had been a mistake, what we found was, while our broad risk parameters were fine, that risk had become more and more concentrated in places like China and places like Brazil. And that was, from our standpoint, an error. We tend to think of, if you think of tracking error, how much volatility there is in your portfolio, we like to spread that around to a number of names so that, for instance, our top 10 names should contribute about 30% of that tracking error. And by midway through 2021, those top 10 names were contributing closer to 45 or 50%, and those were largely in China and Brazil. So it was a positioning challenge that we had recognized, but we hadn't seen as clearly as we should have. And we've worked over the last 3 years to ensure that doesn't happen again. One of the things we've done is work very closely with our risk management team. We have an excellent risk management team at Allspring. to look at our portfolio on a very forensic level, down to the individual security, currency, and country, to understand that risk. And what we've seen is that risk has come down very much so, and has been for some time, within what I would say are historical parameters. And I don't want to drag you through too many pages of the book, but I think it's worth pointing out on page 41 what that looks like. This is I apologize, it's a little bit technical, but this is how much risk and how much tracking error our top 10 securities are producing. And you can see in 2021, our top 10 securities were up almost to 60%-ish of our risk. That's come down to below 40%, which is where we like it. It means the risk in our portfolio is very well diversified and very well under control. In that time period, we've instituted monthly meetings with our risk management team, and in fact, we've helped them develop tools to help our overall firm manage risk on a more granular level, and I think it's been very, very valuable for us. So it is a lesson that we've taken to heart, and I think it's created a more robust strategy. We've done a couple other things I want to talk about that aren't necessarily related to underperformance, but that are important from the point of view of the robustness of our process. We think our process is incredibly strong. Historically, we've never had a period of 5-year underperformance, which is really our investment horizon. And we think that that can continue. But we have made some changes, just two that I'd point out on page 40, let's say. One is this risk management we talked about. Two is staffing. So we added a new senior investor, Gary Tan, in our Singapore office. Gary comes to us with about 20 years of Asian investment experience, first with the Abu Dhabi Investment Authority, then with Natixis, one of our competitors. He's an exceptional investor, and he gives us very senior on-the-ground coverage in Singapore, whereas previously we had one fairly junior analyst. So now we have two investors sitting on the ground. And I think that's allowed us to make sure that we're focused on some of these big macro changes and some of the big flows of capital around the region a little more closely. And then there are a number of other issues we've done around the rest of the process. And my point is, I think we've come through with a very robust and stronger process as a result. And I actually feel incredibly comfortable with where we're positioned now, which probably leads me, if you don't mind, to talk a little bit about our outlook and where we're positioned for that outlook. And I would say just 4 things of note for emerging markets. As sort of the post-COVID world is behind us, for the most part, there are a few things that I think are pretty interesting around emerging markets that we should be aware of. Emerging markets went through a period of very slow growth. Part of that is a reflection of the very strong dollar, which seems to have subsided, and a lot of this is a reflection of probably the very strong growth in the US. That appears to be switching, and if we look forward through 2024, 25 or so, we think even with the sluggish growth in China, emerging markets should outgrow, from a GDP standpoint, developed markets by about 2 to 3% a year. And historically, that is correlated with very strong emerging market returns. And we've kind of seen that over the last year as emerging markets have come back to life. Maybe more importantly, from my standpoint, emerging market earnings growth is accelerating ahead of developed markets growth. I don't need to tell you that our friends in the S&P have had some great earnings growth over the last few years. But as that slows, we're seeing emerging market growth expectations, as we look at our world, more and more positive relative to developed markets. And again, generally correlates to strong emerging markets. And maybe even more important than that, the quality of that growth is much better. One of the things that has really struck me over the last 3 years, where emerging markets have really been soft, and emerging economies have been soft, is that companies within emerging markets have focused on improving their balance sheets and improving their operations. And probably no place where that's more obvious than in China. China, top line growth, revenue growth in the big companies in China has basically been flat, like that economy's on its back. And it has forced Chinese companies to make a very important choice, to move from a stance of growth at any cost, as Chinese companies are wont to do, to a stance of high-quality growth. So we've seen margins improve. More importantly, we've seen cash flows improve, and dividends and buybacks have exploded. Basically, we've gone from growth at any cost to show me the money. And we see this around emerging markets. So I think we're in a period of potentially strong growth relative to developed markets, high-quality growth, and then finally, more drivers of growth. I think 10 years ago, emerging markets was really about getting China right. And that's no longer the case. Now you've got China, certainly important, 20% of our world. But India has joined the world stage as a significant contributor to economic growth. Taiwan and Korea, on the back of the AI, developments in AI, these are the companies that are making the chips and making the hardware that powers artificial intelligence. And then places like Latin America with Mexico and ASEAN, which is Southeast Asia, where as companies, global multinational companies, kind of step back from investing in China, they're looking to put facilities in places like Mexico, places like Indonesia, places like Poland. So we really are seeing a broader-based growth drivers in emerging markets that gives me some confidence that the opportunity set is much more interesting than it was maybe 10 years ago. I don't know how long I've been. I tend to ramble, but maybe I'll stop there and take questions.
Anybody have any questions? I do have one. When I was going through your presentation yesterday, it's on page 6. Can you explain what emotional quotient is? I've never heard that term before.
So EQ, emotional, I think that's a term that they use for, it's sort of the alternative of IQ, right? So there's one thing to be very smart, and then there's another to look at the world in a sort of thoughtful and maybe in the investment standpoint, somewhat dispassionate way. Right? So it's not enough to be smart. There's a lot of smart people in my industry, right? Mm-hmm. It's another thing to take the data that we're sort of inundated with all day and look through it in a thoughtful way and develop patterns and think about what does this sort of deluge of information mean as we look forward. So it really is, I think it's a term, and forgive me, this is our top-level firm marketing documents, but it's a term that was coined, I think, back in the 90s for, hey, it's not enough to be smart, you got to be thoughtful about these things.
Okay. Anyone else have any questions?
Sure. Yeah, our little footnote there.
So can you just touch on that? Where is Taiwan Semiconductor? What is the weight of that in the index?
Yeah. So, yeah,
Can you-
TSMC, Taiwan
can you-
Semiconductor,
can you- yeah.
which is the largest silicon chip manufacturer in the world, has become a very large piece of our benchmark. It's give or take about 10% of the benchmark. And that creates challenges for investors like us. It is helpful that is, categorically one of the greatest companies in the world, but it does, from a risk management standpoint, create issues. We manage that in two ways. One, we do have guidelines around how far away from above or below the benchmark weight on a stock that large that we can be, because we want to manage our tracking error and our volatility. But maybe more importantly, one of the things we track very carefully, as I mentioned, is that contribution to risk. Right? So if we're 12%, I think, give or take, in TSMC, we can sit down with our risk management team and understand how much risk in terms of relative and absolute performance does that create for our strategy. And the answer is there's two pieces to measuring that risk. There's one, sort of how big is it, and two, how volatile is it. And TSMC, generally speaking, it's a cyclical company, so there is some volatility, is not particularly volatile. Imagine if we owned 12% of a very small internet company in China. That would be very, very volatile and create a lot of risk in the portfolio. Whereas TSMC, we manage very carefully how much risk we're taking as we go above or below the benchmark.
I had a question kind of similar to that, and I guess I wasn't quite clear on, you talked about the concentration of your top 10 holdings and how that contributes to the risk. And I guess I've seen, concentration, what percentage of your portfolio is. Maybe you could talk a little bit, is that kind of what you're talking about here, the risk concentration is different than just what percentage you're holding of those top 10 companies, but again, how they factor into your earnings and that sort of thing?
That's exactly right. So what we're looking at is not so much, or not just, how much we own of that company versus the benchmark or versus an absolute term. And that's a big contributor to risk. But also, how volatile is that company, right? So if I own a toilet tissue manufacturer, right? We kind of know what their earnings are going to be, and it's a pretty stable business. It's not particularly volatile. So even if I kind of own a bit more of that than another company, it may not contribute as much risk in my portfolio from a volatility standpoint. Whereas if I own, well, in this case, we can look at this on page 41, that biggest contributor to risk back then. You can see that dark blue bar back in 2021 was a Chinese internet company called Bilibili. It's kind of like YouTube in China. Very good company, but Chinese internet companies are pretty volatile. So it was contributing, even though it wasn't, it was a big position, but it was contributing a lot of risk because of that volatility.
Anyone else? Okay. Well, thank you all
Thank you.
very much for joining us this morning.
Always a pleasure.
Okay, we will jump back on the agenda to item 12B, which is fixed income portfolio review and discussion.
Okay.
Good morning again.
Good morning again. Switching topics from emerging markets to fixed income. As we discussed last month, there's been quite a bit of organizational turnover at Western Asset Management, one of your largest fixed income manager in your portfolio. Beginning earlier in the year with the retirement of John Bellows, who was replaced by Mark Lindblom, who was also nearing retirement, followed by C.I. Lang, who was the portfolio manager for the emerging market sleeve of the Core Plus strategy, which is a significant sleeve. And then most recently, Ken Leach, the co-CIO, being put on administrative leave as a result of a Wells notice and SEC investigation that as of now is focused on Ken Leach and not necessarily Western directly, although if something happens, Western will become involved in that. That's led to pretty significant redemptions from investors. Many public funds you may have read have gotten out of the fund. And so our opinion is where there's a lot of smoke, there's just issues and there's other strategies that we should consider. So today, we want to talk about some potential candidates to replace Western and potentially Brandywine. And I know we weren't talking about that, but I'll get into why in a moment. But if you go to the next slide, this hopefully is familiar. This is your fixed income portfolio structure, how we've structured your fixed income allocation. One of the things you may recall from an asset allocation standpoint, we slightly bumped up the overall target to fixed income from 20 to 25% earlier this year. And pro rata, we kept the same allocations of the underlying sleeves. So core bonds, which is the most liquid and it's high quality investment grade bonds in the U.S. We're implementing that through an index strategy with State Street, and that's 5% of your portfolio. This middle section, what we've defined as multi-sector, that we're targeting 15% of the total portfolio in multi-sector, which is just more dynamic strategies. And we've been implementing that for many years with a core plus manager in Western that really has the ability to go 20 to 30% in what are considered plus sectors. So this would be high yield, emerging market debt, floating rate debt, non-US developed market debt, just other things out that aren't in the Bloomberg aggregate index to add value over time. And they don't have to constantly be there, but they can ratchet those allocations up and down over time. Western doesn't do a lot of non-US, and so we've complemented them in what we're calling multi-sector with a smaller allocation. It's about 2/3 Western and 1/3 Brandywine, and Brandywine is a global bond manager. So they are focused on non-US bonds, primarily developed markets, developed and emerging market sovereign bonds, government bonds. That has added value over time, but it tends to be very volatile. You get a lot of currency risk there. The third leg of your fixed income allocation is what we call unconstrained. Today, that's PGIM. This is a totally liquid strategy. They're investing in bonds, but they do have the ability to go long and short, and they also will have the ability to move interest rate risk or duration around quite a bit. That has been very beneficial in the period of 2022 and 2023 where we saw rates going up dramatically. This strategy provided a lot of protection. Going forward, we think that has a meaningful place in the portfolio is to mitigate some of those other things and to be a little bit more dynamic. But going forward with rates where they are today, having some duration in the portfolio is beneficial. So we're really focused on this multi-sector section, this two managers, Western and Brandywine. The impetus is because of qualitative issues at Western. If you go to the next page, we're presenting to you two potential replacement candidates that would really be two different paths. The first is Janus Henderson. This is a true core plus manager, not fully multi-sector, and you'll see that in their allocation. So this would be a one-for-one replacement for Western. From a sector allocation standpoint, or the sectors they're in, 30% investment grade corporates, about 52% securitized. So these are agency mortgage backs, CMBS, commercial mortgage-backed securities, and asset backs. Similar to what Western is doing. Overall credit quality, down at the bottom, that ratings quality, it's a little bit apples and oranges. Western is putting all of their governments and agencies in AAA, and one of the rating agencies rates them as AAA still, but the two others are not. I think the more appropriate measure there is the average credit quality up at the top. You'll see they're both A plus to A, both of those. Pioneer, the other candidate manager, this would be what they would describe as a true multi-sector manager. So they're a little bit more dynamic in their approach. And the things that will stand out here, a little bit, the overall credit quality a little bit lower, still A minus, still in investment grade. They're going to be a little bit more in high yield. You'll see today they're about 11%, although this does fluctuate around. The other piece that you see there looks big. What that really is it's two things: Yankee bonds and 144As, which are privately placed corporate securities. So they're not rated by a rating agency, but they're doing the same credit work on those. And Yankee bonds are the bonds of non-U.S. Either corporations or sovereigns that are denominated in dollars. So you're not getting that currency impact like you do from the true EMD or the non-U.S. But you'll see currently non-U.S. and emerging market debt, they have about 14% there, where Janus and Western a lot lower. Compared to we dropped Brandywine in there, and they're at 24.8%. That's what they're doing in the portfolio. We have another slide where we roll things up and look on a portfolio basis that I think will be helpful. So the difference between these two strategies, as I described, Pioneer, more multi-sector. If you go to the next page, I think it's probably a little better. Really what we're trying to do with this 25% fixed income allocation, fixed income is to provide an income component, stability, less volatility than equities, but also generate some return. But from an objective standpoint, overall, we're trying to generate a return above the Bloomberg Aggregate Index, which is a intermediate duration index for a pension plan. We think that's an appropriate measure. And so we're implementing some things that are doing a little bit different as we showed. Pioneer, from a tracking error standpoint, so risk relative to the benchmark, it's a little bit wider than what you see from a Core Plus manager. From a duration risk standpoint, both of them are going to be plus or minus 2 years of the index. So they're going to stay pretty close to the index in duration, which is different than PGIM on the unconstrained strategy. They can move around a little bit more. So the way to think about this is Pioneer is just a little bit more flexible and dynamic in their approach. Next page. This is looking if we rolled them up in the same weights that we're currently rolling things up. So your current portfolio, and this is just looking at this multi-sector section, this 15%. So it's 2/3 Western, 1/3 Brandywine is the current portfolio. As of now, that has a 5.9% yield to maturity, so above the aggregate benchmark, so we like that. A duration 5.6, so a little bit lower duration as of now, which you'll see all of these combinations have a little bit lower duration. And the average credit quality of A+. Take you down and really looking at the non-US and the emerging market debt, that combination, 2/3 Western, 1/3 Brandywine, you've got about 9% emerging market debt and 3% non-US developed. If we replaced WAMCO with Janus Henderson, just a straight swap, Core Plus for Core Plus, and kept Brandywine in the portfolio, you see where the credit quality doesn't change, the duration really doesn't change, the yield to maturity really doesn't change. It's a similar structured portfolio. A little bit less in emerging market debt and non-US because Janus doesn't have quite as much there. The other direction would be replacing both managers with a single manager in Pioneer, which, as I mentioned, in this multi-sector space, a little bit more dynamic. A little bit lower credit quality, still investment grade at A. You see a much higher yield to maturity currently. Duration comes down a little bit. They're just currently investing in a little bit shorter duration securities. And also what's bringing duration down in this case is Brandywine on the global bond side. Their duration is pretty long. They have a lot longer duration bonds. That's why we see pretty big fluctuations in performance for a Brandywine because their duration is about 8 years. So it's just typical in non-US. So this would bring interest rate risk down a bit, but still exposure to those non-US sectors. You see the non-US and emerging market debt stays pretty close to, at least at the moment, this is a snapshot in time, at least where it is today. From a quant standpoint, if we just move forward here, you'll see this Amundi strategy, and this is backward looking, we recognize this, but it stands out pretty nicely, and I think the next page is a little bit better, what I want to highlight. Where the 2022, this is calendar year, rolling one-year calendar returns, even though this is a more dynamic, flexible strategy, that's not necessarily risk. Because they had less rate risk and less treasury exposure, they were able to provide, that strategy provided quite a bit of protection in that down year of 2022 for bonds, where the benchmark was down 13%, they were down about 12, and you see these others really with the Brandywine, a lot more duration. Western had a little bit more duration. Again, this is backward looking and positioning, but the point of this is to say, even though they have more flexibility, it does complement quite nicely the rest of the portfolio. If we go forward a couple pages, there we go. Go back one, I think. Yep. This is looking at the combinations again. If we had our current portfolio, which is, it says 10% Western, 5% Brandywine, that's of your total portfolio. This is really 2/3, 1/3 allocation between Western and Brandywine. If you swap that Janus for Western, what that would look like, the more recent 1-year return, a little bit better, 5-year return, a little bit better, 10-year return, about the same. With a single manager, just using Amundi, that 10-year return is about 200 basis points higher than the benchmark and than those combinations. So as we look at this, while the impetus for this discussion is really qualitative changes at Western, we felt it was appropriate. Let's take a more holistic look at the fixed income allocation and see if there's some better solutions. So today, I don't know that there's action to take. What I'd like to do is just get some direction from you all. Our recommendation would be to go in the direction of a single multi-sector manager and pioneer. And if you were so inclined, we would recommend that you have them in for an interview at a future meeting. But if you're, again, this isn't, nothing's broken with Brandywine. This just would alleviate some of the volatility that we're experiencing, and we think it's just a simpler solution.
Yeah, I don't want to speak for everybody on the board, but I think it would be good if we could hear from the pioneer before we make a decision.
And I assume that the returns that you're showing here are also net of fees. Is that correct, or?
These, for Amundi, they are net of fees.
Okay.
Yep. And that, because that's we're showing the fund. Others, well, that one is your actual portfolio, so that is net of fees as well. Not sure why we didn't do that. The Janus Brandywine may not be net of fees, but the fees aren't that much. It's not all fees. The fees, for this size, we were able to negotiate a pretty favorable fee structure. The Janus Core Plus would be the first $200 million at 28 basis points, so that's, and the Pioneer Multi-Sector, it's the first $50 million at 30 and the next $100 million at 25 basis points, so it would come in around 29 or so basis points, because I think this allocation it's over 100 million currently.
And I just have a general portfolio question. You know, judgments is also in this component. I assume we buy up every judgment we can because those are super safe and pretty high return. Is that accurate or not?
I honestly don't know.
Yeah.
I can speak to the judgments, and that really is, as they come through, the municipal counselor's office makes the recommendation that the retirement system purchase those. Pretty much all that come through we purchase, unless there's a specific reason the municipal counselor's office suggests that the retirement system does not purchase those.
So why we're showing that there is we have to put them somewhere.
Right,
So
yeah.
from a measurement standpoint, so
Yeah.
we include them. They're private, they're illiquid, so there is a little bit, while they're safe and they're going to be paid, there's a little bit of a difference in that they're illiquid. You couldn't sell it.
Okay. Thanks.
Okay, well, we don't have to take any action, but I think we would definitely like to hear from Pioneer.
Okay,
So, okay.
okay.
All right, very good. We will move on to item 13, which is the monthly investment report.
All right. Endpoint time periods mean everything. I don't know if you've noticed that looking at the September report, but I was talking to Randy coming up the steps, and if you look at 1-year returns right now at the end of September, pretty extraordinary across every asset class. If we go back a month or 2 months, even the 10-year return, I've looked at some just from index data, the 10-year annualized return from the end of June to the end of September for most asset classes went up 1.5% to 2%. Because we're taking off, at least on the last year, last September, or the third quarter of last year was a bad quarter. And we're taking that off 1-year returns and adding a really strong quarter. So on page 3 here, you'll see market returns for the month of September and year to date, and those don't fully show what the 1-year return is now because the fourth quarter of last year was a very good quarter. But large cap continues to be the best performing asset class, up 22% on the year. Emerging markets up 17, international up 13, small cap up 11. If we go forward and just look at, if you go a couple pages forward to the performance and look at that 1-year column, take you all the way down to fixed income. The trailing 1-year return for bonds at the end of September was 12.35% on a gross basis. The index was up 11.5% on a 1-year basis. Our capital market expectations for bonds, we talked a lot about this at the beginning of the year, and our capital market assumptions aren't for the next year or the next 6 months. They're looking out 10 years and longer. Our expectations were much higher than they had been, but more in the 5 to 5.5% range. So this is really 2 years of returns packed into 1 year for bonds. So we got a pretty big tailwind from rates, intermediate to longer term rates coming down quite a bit during the quarter. Actually, they've popped up a bit this month, the 10 years back at 4%, but still we're in a much better place as a long-term investor with higher yields. But you go up that column, emerging markets up 20+%, international up 20+%, small cap up 20+%, large cap up 35%. So your total portfolio on a 1-year basis up 17, a little over 17%. Trailing the policy index, same sad story. Not really a sad story, but the same explanation. It's private equity that is causing most of that dispersion there. As we have 10%, we're almost 10% in private equity, certainly lagging public markets. We're comparing that in your policy index over the short term to the S&P 500, and right now that's a 28% differential. So you've got, that's 2.8% right there. 10% times 28% is 2.8% of the dispersion right there. Longer periods of time, as we've talked about, your private equity has been beneficial. If we look out over 10 years, your private equity portfolio annualized a 14% return versus the S&P up 13.4. So things are looking pretty good from a market standpoint. As we look at individual managers, I think we've talked about the one where there's some issue. It has been challenging for active managers really across the board to keep up with indices because of concentration in a handful of names, but that doesn't mean you're not participating. As we've talked about quite a bit, we want to participate in the upside and protect in down markets, and this portfolio is certainly doing that. And we're pleased with where things stand, with the exception of a couple of qualitative factors with some managers that we feel we can make some tweaks and improvements on the margin.
All right. Any questions for Jason on the monthly report? Okay, hearing none, Chair will entertain a motion to receive the report. Thank you, sir. We have a motion and a second. Please record your vote. Item is approved. Item number 14 is comments from board, staff, or citizens. Anyone have anything this morning? I'll say it was a very good conference that we attended last month. So hopefully next year's will be just as good or better. So, Okay, we are adjourned at 10:49. Thank you, everyone.